Good afternoon, traders. I trust you are well and having a fantastic trading week. We've had a few questions sent in from our recent members that I'm going to answer today. Of course, if you've got any more questions, fire away. You can follow us, subscribe, drop us a DM, and of course, we'll get back to you. So, number one, is Forex trading really profitable, or is it just a glorified gambling scheme? Of course, it's profitable. However, it's a profession. If you have the mindset that it is a get-rich-quick scheme, or you think you can flip £100 into 10K quickly, you are a gambler, and yes, you will fall into the category of becoming a gambler. If you want to give this 6 months of hard work, commitment, be patient, be disciplined, be decisive, spend time on our trading floor, meet the team, myself, find strategies that suit you as an individual, and work hard, then yes, you're going to learn a craft, a skill, and you're going to learn how to be competent in the financial markets, across some volatile markets too, and that will lead you into becoming a consistently profitable trader. But it takes time. You must be realistic with your expectations, and of course be risk managed. We risk anywhere between 0.5% to 1% per trade, meaning that we want to target 1% gain per trade at a minimum. So depending on the capital you have available to trade with will depend on what sort of outcome you're going to see. If you're some sort of trader trying to target 200-300% in a month, you might do it month one, but by month two, you're going to blow yourself up. And I'm sure many of you may have done that already. So realistic expectations, slow and steady, risk one, gain one, risk one, gain one. Get consistent, get good, build a success rate so you're winning 7 or 8 trades out of 10, and then come and spend time on the trading floor. We'll show you how to get to the next step. So no, it's not gambling. However, it is easy to gamble if you think you can get rich quick. Hope that answers that one, guys. Number two, can you actually start trading Forex with $100 or £100, or is it just a marketing myth? Technically, yes, you can trade with as little as $100. Majority of the brokers out there now are quite easily accessible, and you can deposit even smaller than $100 to start trading. However, you will naturally be over risking. The bare minimum that the ideal amount for a brand new beginner, I'd say is £1,000. But as long as you are going to risk manage. So you can risk 1%, gain 1%, and it's a little bit of money that means something. Complete minimum would be about 500 quid. You can still risk manage and trade size correctly. However, trading such a small account size, it's not emotionally grabbing. You could start with £500. You could make 50 quid in your first month, 10% growth. On paper, that's amazing. I will tell you, that's amazing. However, £50 a month isn't going to change your life. So if you've worked hard and perhaps you've spent 12 hours a day at your charts and you've only seen 50 quid gain and you're working a part-time job earning a lot more than that, it's going to be very hard to get your head around your outcome for the amount of time you're putting into it. So if you are starting with a small trading account, just be fully aware that the profit is going to be nothing but not exciting at all. And you must think about the percentage growth. Once you're consistent, if you're targeting 10% a month and consistently achieving that, people will throw money at you. So kind of to summarize, guys, yes, it is minimum entry level. However, you're going to be naturally over risking, which isn't good. If you can start minimum 500 and still trade size correctly, think about percentage growth, not profit or monetary value. I think you'll do well. Number three, why do Forex traders fail in their first year? I'm sure you've all heard of the 90-90-90 rule. 90% of traders lose 90% of their capital in the first 90 days of trading. I kind of just spoke about this. This is more to do with, again, the amount you're trading with. If you're starting so small with huge expectations, you're going to force yourself to over risk. There's over $7 trillion trading the market on a day-to-day basis. It's volatile, it's wild, it's mad. You'll get caught out if you don't have a strategy, a plan, and of course, if you're over risking. So it will put you guys in a bit of a position. If you are over risking and you're not fully educated, no support, no mentoring, no hand holding, you're going to fall into that 90% category. The other is undereducated, underfunded. So again, you have huge expectations and you're over risking on such a small account and you're not happy with percentage growth. Undereducated simply means you're trying to outsmart a huge market, and lack of support, mentoring, and guidance. You need somebody to hold your hand who's been through every experience emotionally and physically, that can talk you through when to hold fire, when to adapt to current market sentiment. If it's busy, volatile, quick, or perhaps that's your trading habit and style, you need to be pushed in that direction. If you're someone that's a little bit more risk averse, you're slow, steady, long-term growth, perhaps you've got a full-time job, so you're forced to trade an end of the day, higher time frame strategy. You need to be told when the market suits that style. So the ability to adapt is key, and that only comes with experience. So underfunded, undereducated, and lack of support and guidance. Number 4, what's the single biggest mistake that newbie Forex traders make? That's quite simple, over-risking, fact. A lot of brand new traders, again, will have beginner's luck, like in anything, and they'll over-risk, they'll blow themselves up. It's typical. The next stage after that is analysis paralysis. So you've got burnt, but you see the potential because perhaps your first week or first month was huge for you. You might have earned a month's wage in a couple of days and thought, wow, I see the potential. However, I'm not educated enough for me to do that right now. So the next kind of stage after that is analysis paralysis. You go on YouTube and you pick up all these gurus, tips, tricks, and robots and whatever it may be, and you try and outsmart a huge market with minimal effort and just trying to cherry pick certain people's strategies themselves. Again, that's not going to work. The third stage after that is you find your niche, but again, you're sick and tired of perhaps peers and other people around you making fortunes, and you slip back into that old mindset and again start to over-risk. Change your strategy, change your style. When you get to a position where you are consistent, and that's come through hard work, persistence, being patient, being disciplined, learning around your learning style. So if you're a visual learner, get someone to teach you visually and not give you a load of books to read. But also when you find a strategy that suits you around your employment, your routine, your lifestyle, the way you approach the market, your risk appetite, pretty much everything complete. When you find that, it then needs 6 to 9 months minimum of back testing and then forward testing. And then finding markets that suit you and don't suit the style, tying in some seasonality and looking at historical performance of assets that are trending if you're a trend-based trader. So there's different stages to growth, and a lot of new traders not willing to work hard and go through these stages. So for those that come onto our trading floor, I say that day one, if you're not willing to work hard or not willing to give 100%, then walk away. Just get out of here, to be honest. If you are willing to see a profession out of this and learn a skill for life that you can use anywhere in the world on a day-to-day basis, then you're in the right place. But you've got to give yourself time. You see all these things online, and it sounds a bit cliche in saying it, but again, doctors study for 8 years plus more to become a doctor. Teachers study for 4 years plus an additional 2 years on their chosen subject. So for them to be qualified, it's 6 to 8 years. So for you to just rock up and think you can be a trader overnight is quite disrespectful to myself and those around me that actually spent years and years studying this. So start to realize where you are, guys, and again, what your goals and expectations may be. How can technical analysis be reliable in Forex trading when the markets are influenced by unpredictability? Okay, so good question. From personal experience, 10 years ago, yes, fundamentals drove the market. Fundamentals were clear, interest rates go up, economy rises. That's pretty straightforward. On paper, that's how it should be. If you look at perhaps the last 2 years or 3 years, and you look at the results and the numbers that have come out on the back of the data and how that's affected the market, it's typically giving a negative impact. We're seeing job numbers up and also being strong for the economy. We're seeing interest rates go up and having a negative impact on the economy. So it's not how it was all those years ago. And that's down to the amount of money that's involved now, the amount of influential people that are speaking and talking about the market and that can move the market. To give you an example, Donald Trump, when he was in power, he would tweet something and the market would go ballistic. 15, 20 years ago, you would never have had the President of the United States on Twitter blasted his mouth off, which again has a knock-on effect to the market. So it's a changed market now. You need to adapt to current market sentiment. And for me personally, I may be wrong, and feel free to prove me wrong, but stats don't lie. And if you look at the stats of the numbers that have been out over the last couple of years, again, to talk real basics, interest rates up, economy's gone down. That's not how it is on paper. So the market nowadays is completely different. In regards to favoring technicals, it allows you to approach the market in a disciplined way and have the same structured entry time and time again. And by entering in the exact same manner, time and time again, it will allow you to build a success rate. And when you have your success rate, you're happy with that success rate, you simply play the probability game moving forward. You know you're going to win 7 or 8 trades out of 10, and you know this strategy works on many different market types or different asset classes, so you simply rock up with no emotions and you play the long game, you play the probability game. And that will put you in a position that where you're consistent, you're confident, there's no emotions, and you don't care what markets you trade or what asset type it is. You rock up, that particular chart or asset meets your strategy, you take it, you leave it within your risk parameters, and whatever your management style may be, whether it's walk away or close after 20 pips, do whatever you need to do, but have emotions away And that will only come when you have a success rate built up over several months or years worth of data. Next question, why do brokers offer high leverage if it's so risky? There's certain types of brokers in this industry. So you have an A and B book side. B book side, to give you a brief example, is when your trades are not put direct to market and essentially the broker pockets your deposit and you're trading on virtual funds. Those virtual funds, again, will be according to your profit and loss, will obviously move up and down. Any withdrawals are made are out of the broker's pocket rather than taking your trade to market. How this works is that when 90% of the industry fail, as we've just discussed, the brokers are simply banking on 90% of deposits being lost, therefore put in the broker's pocket. Now, for the small percentage of people that do withdraw regularly and consistently, that's paid out of the losing trader's pocket, if that makes sense. A side, you're putting your trades direct to market. So that's where the broker takes a spread. The spread is the difference between the bid and the ask, the buy and the sell price. Essentially, it's marginal depending on what currency pair you're trading, and that's their processing fee for putting your trade in and out of market. There's some certain ways that you can identify A and B book brokers. You can always ask, although some may tell porkies, but a lot of brokers that advertise very, very high leverage, zero spread, zero commissions, flashing lights, come and trade with me, we'll dump loads of bonuses in your account. They're typically your B book brokers that are surviving on 90% of traders losing. Your brokers, like, there's quite a few, your IG indexes, your Intertraders, your Pepperstones, a lot of Vantage as well. They typically put majority of trades to A side, and simply that's a broker that has your interest at heart. They're built by traders, for traders, and they simply want you trading and making money. The more money you make, the higher lot size you're going to trade, the higher spread value, the more the broker makes. So start to think about that. Again, at a beginner level, it's not too important, but as you start to progress and deposit more funds into your trading account, it's definitely something to think about. So avoid brokers that are offering bonuses and high leverage and everything else. They're probably not going to have your best interest at heart. Can you really trust Forex trading signals, or should you solely rely on your own analysis? Personally, 100% rely on your own analysis. Even if you find someone that's banging out amazing signals, what if they close down tomorrow? What if they decide to pack up and stop giving signals? You're back to square one. Problem with signals is you don't know the intention behind the trade that's taken. So you're not going to know how to manage it correctly. You're not going to know the risk side to it. You're simply just gambling, praying for the best, hoping that that guy's signals are going to make you a few quid and you can withdraw. However, as we know this industry, 90% of people lose. So the odds are not in your favor if you're copying someone else's trades. A lot of these guys are 18 or 19 and hammering Instagram, pretending that they've been trading for 10 years. Obviously, they haven't. And simply bang out these signals 100 a day to attract novices and newbies or people desperate for money, because this industry does attract people desperate for money, and that really isn't the case. This industry is, again, a profession. It's time, dedication, commitment. So if you are a newbie and struggling for funds, Forex trading is probably not for you. It is for you if you're willing to work hard and build a career out of this. So for me, signals, yeah, look, it could be a great start for you to get into the market. However, learn your craft. I could teach 100 people the same strategy and walk away. And I guarantee the first trade they take, each one of them are going to close the trade under a different circumstance. And that's going to come from personal opinion, personal belief, scared because they're losing, scared because they're winning. So you have to find what suits you. Trading isn't one shoe fits all. Trading must be tailored to the individual. When you're learning, around your learning style, and when you're executing and trading, around your risk appetite, what you see, what you feel, how you behave around a live trade. So emotions play a huge part in trading. That's why you can't just copy somebody else. Is algorithmic Forex trading just a fad, or is it the future of the market? If you would have asked me maybe 5 years ago, I'd have said absolutely not. However, the market's changed, technology has changed, and some of these bots and algorithms that we're seeing are amazing. One thing I'm always cautious of is the risk element. Being an individual trader, you can manage and handle your own personal risk, meaning you're in full control. If you're putting 100% of your capital in the hands of a robot that could go wrong, or an EA that perhaps may be fine-tuned enough, or can't handle huge volatile periods of the market or unexpected news announcements and the market bonkers, then you're kind of putting your hard-earned cash into a robot's pocket. So, or putting control of it into an EA or a robot or some sort of algorithm. So I would always be very, very focused around your risk and your risk appetite and how you can protect your capital. As traders, we are risk managers, not risk takers. And of course, preservation of capital is rule number one. So that's something I would always put first thought if you are looking down that rhythm. However, they are getting good. I know of quite a few that are performing exceptionally well. And if you want something perhaps more hands-off, it could be a route you take. But I would still suggest learning how the financial markets operate so you can understand the process behind the algorithm working. What are the ethical implications of Forex trading? Does it serve any real economic purpose? So a lot of the industry get mixed up with this. I see a lot of people selling institutional tools, institutional data, institutional strategies, institutional order flow, institutional bollocks. It's all a load of crap in my eyes. I've seen it firsthand. You've got to think of how institutions work. A lot of it's for physical product or physical dealing in terms of cash swap. So if you're exchanging X amount or yards of euro into dollars, it's usually a physical exchange. Therefore, they're not sitting on MT4 speculating, trying to work out what the trend line's up to. Another rumor that I consistently see is people believing that they're stop loss hunted or that institutions have killed them. That really is not true. Institutions, we're not a teardrop in the ocean to any bank, major hedge fund, major institution. They do not know who we are. They do not care who we are. And I'm sure it would have to be an exceptional amount of weight put direct into market. Remember, not be booked, which a lot of the market is, direct to market to even float any sort of teardrop or ripple into the exchange or clearinghouse at all. We wouldn't even see a ripple in the market if the whole of the UK went long on euro dollar. It just wouldn't even ripple the market. So you've got to think about what trading really is. This side of the industry is completely different to institutional trading. Although some may fool you and believe that institutional order blocks are available, it's not. They do not trade how we trade. They are not sitting speculating on charts, flirting with them as the market moves. They have the power to move the market on physical exchange. To give you an example, in fact, there's an even better example online. If the Mexicans were to buy oil from the Saudis, physical product exchange, the difference between Mexican peso and Saudi oil is completely different. The economies are miles apart. However, both local currencies will convert back to USD and the deal will be done in dollars, therefore affecting the value of the dollar. That is a physical world trade deal. That's not someone sitting on MT4 having a flirt with a couple £100 in their account. So we've got to understand the purpose of this. We are retail traders that speculate on market moves. The institutional side of the world do not do what we do. They do not know who we are or care who we are. Therefore, there's not much similarity between the two. And a lot of people need to understand that. What would happen if everyone used the same trading strategy? Would the Forex market collapse? Absolutely not. However, as we just discussed, a lot of the actual trades are not even put direct to market in this industry, 90% I would say. So all it would do is just fill up someone's pocket or empty someone's pocket, being a broker. In regards to if it went direct to market and was put through to a traditional exchange, potentially it might cause a ripple in the market. I wouldn't think it would cause much. Also, we've got to remember with strategy, we could all trade the same strategy, but I might be more patient than yourself. So I might wait for a better confirmed entry, get in at a later stage. You might be a bit more aggressive, see the strategy and think you're going to get in really quick and really early, and therefore have a different outcome to me. So we've always got to think about that. And that's why I said trading isn't one shoe fits all. You need to find what you believe in, what you enjoy, what you see, what you believe. Build a success rate that you can see perhaps over the last 10 years, the strategies work 7 or 8 times out of 10. Back test it, believe in it, forward test it, put your real hard-earned money into it, see how your emotions are in and around your live trading, and then continue from there. That's all the questions for now, guys. I hope that answered some of them. And of course, if you do have any further questions or you want to challenge anything I said, feel free to get in touch. You know where we are. We're here in Chelsea on the trading floor, or you can drop us a message, drop me a DM on Instagram or whatever it may be. But anyway, guys, if you are on your trading journey, keep working hard, keep learning, keep adapting to current market sentiment. It's volatile, especially today with CPI figures. So stay safe, and I hope to see some of you soon.